Something unprecedented happened in the first week of February this year, and almost no one in mainstream financial media reported it. Bloomberg confirmed, citing sources inside Beijing, that Chinese authorities issued a direct order to their state-run banks. The instruction was simple: stop buying United States Treasury bonds. This was not a market rumor. This was an official directive from one of the two largest economies on the planet to its financial institutions, telling them to actively reduce their exposure to American government debt. And China is not alone. What I am about to show you is a pattern that has been building for over a decade, but has reached a breaking point in the last 12 months, a pattern involving dozens of countries, trillions of dollars, and a coordinated exit from the financial system that has underwritten American prosperity since 1944. The central banks of the world are executing an exit strategy. They are dumping dollar assets at a pace that has no historical precedent. And they are replacing those assets with something that no government can print, no politician can debase, and no sanctions regime can freeze for the third consecutive year. And the implications for your savings, your retirement, and the purchasing power of every dollar you own are so significant that I could not wait another day to bring this to you. Let me start with the numbers, because the numbers tell a story that no politician or central banker wants you to hear. As of November 2025, the most recent data available from the United States Treasury Department, China's holdings of American government debt stood at $682.6 billion. That is the lowest level since September of 2008. To understand the magnitude of this decline, you need to know where it started. In 2013, China held $1.3 trillion in United States Treasuries. It was the largest foreign creditor of the American government. It was the anchor buyer at every Treasury auction. It was the bedrock of the system that allowed Washington to spend trillions more than it collected in taxes year after year after year. Today, China holds barely half of what it held a decade ago. It has shed more than $500 billion in American government bonds over the past 14 years. And the pace is accelerating. Between January 2022 and December 2024 alone, China cut its Treasury holdings by more than 27%. That rate of decline is nearly double the pace recorded in the previous 7 years. And now, with the February directive to state banks, the selling is expanding beyond the central bank itself and into the commercial banking sector. China's share of total United States Treasury holdings has fallen to approximately 2%. 2%? China is not simply selling treasuries and sitting on cash. It is executing a deliberate, documented, multi-year strategy to replace dollar assets with gold. According to the State Administration of Foreign Exchange, China's official gold reserves stood at approximately 74.15 million troy ounces, roughly 2,300 metric tons, at the end of 2025. The People's Bank of China had been purchasing gold for 15 consecutive months through January of this year. And gold's share of China's total foreign exchange reserves surpassed 9% for the first time in November. Now here is what makes this even more significant. Multiple analysts believe that China's actual gold holdings are substantially higher than the official figure. Australia and New Zealand Banking Group estimates that China's real gold reserves are closer to 5,500 tons, nearly double the reported amount. If that estimate is accurate, China would rank second globally, behind only the United States, with approximately 8,000 tons. The reason for the discrepancy is strategic. By gradually revealing purchases rather than disclosing the full stockpile, China can continue accumulating without triggering panic buying in the gold market or drawing unwanted attention to its diversification strategy. It is, in the most literal sense, a stealth operation being conducted in plain sight. And China is not the only country executing this playbook. Central banks worldwide purchased over 1,100 tons of gold in 2025. That was the third consecutive year above 1,000 tons. To put that in context, the average annual central bank gold purchase between 2010 and 2020 was less than 500 tons. Central banks have more than doubled their buying pace in 3 years. Global central bank gold reserves now exceed 36,000 tons. The World Gold Council reported that in the second quarter of 2025 alone, central banks added 166 tons, a figure 41% above the quarterly average. This is not retail investors buying coins at their local dealer. This is the monetary authorities of sovereign nations making massive, sustained, price-insensitive acquisitions of physical gold. They are not trading for short-term profit. They are building strategic reserves, and the list of buyers reads like a roster of countries that have collectively decided to reduce their dependence on the American financial system. China, India, Turkey, Poland, the Czech Republic, Singapore, Brazil, Azerbaijan. These are not fringe economies. These are nations representing billions of people and trillions in GDP who have looked at the trajectory of the United States dollar and made a calculated decision to diversify away from it. And the pattern extends beyond the usual suspects. Japan, which remains the largest foreign holder of United States Treasuries at approximately $1.19 trillion, has shown its own signs of strain. Bloomberg reported that in advance of major Treasury auctions in February, there were discussions about whether Japan might use its Treasury holdings as a negotiating card in trade discussions with Washington. Japanese officials quickly walked back the suggestion, but the fact that it was raised at all reveals the degree to which American debt is now viewed as a geopolitical lever rather than a risk-free asset. The United Kingdom, the second largest foreign holder, reduced its portfolio from $904 billion to $865 billion in a single month in late 2025. Globally, total foreign treasury holdings slipped to $9.249 trillion in September from $9.262 trillion the previous month. The numbers are not dramatic in any single month, but the trend line, viewed over years, is unmistakable. Foreign governments are reducing their proportional exposure to American debt while dramatically increasing their exposure to gold. The foreign share of debt held by the public has fallen from 49% in 2011 to 32% in 2025. That 17 percentage point decline represents one of the most significant shifts in the structure of global sovereign finance in the post-war era. Now, I need to explain why this is happening, because understanding the motivation is the key to understanding what comes next. There are three forces driving this exit, and they are all accelerating simultaneously. The first force is the weaponization of the dollar. In February of 2022, when Russia invaded Ukraine, the United States and its allies froze approximately $300 billion in Russian central bank reserves held in Western financial institutions. Overnight, assets that Russia's central bank believed were sovereign and untouchable became inaccessible. They were effectively confiscated without a trial, without a court order, without due process. Now, regardless of your views on the Russia-Ukraine conflict, the implications of that action sent shockwaves through every central bank on the planet. The message was unmistakable. If you hold your reserves in dollar-denominated assets within the Western financial system, those reserves can be seized at any time by a political decision made in Washington. China watched that happen and accelerated its treasury sell-off by 27% in 2 years. India watched and began buying gold at record pace. Turkey watched and nearly doubled its gold reserves. Saudi Arabia watched and began accepting non-dollar payments for oil. The freezing of Russia's reserves was the single most consequential financial event of the decade, not because of what it did to Russia, but because of what it told every other country about the safety of their dollar assets. And this is not speculation on my part. Sean Rain, founder and managing director of the China Market Research Group, stated publicly that the Chinese government is pursuing de-dollarization, specifically to shield itself from economic pressure from the United States. The State Administration of Foreign Exchange in Beijing began adjusting its dollar-heavy asset allocation as early as 2017, but the pace of adjustment after the Russia asset freeze was dramatically different. Between 2015 and 2022, China reduced its treasury holdings by roughly 17% over 7 years. After the Russia freeze, China cut an additional 27% in just 3 years. That is the quantitative signature of a policy inflection point. And it was not just governments. Chinese retail investors have flooded into gold as well, driving prices to an unprecedented high of $5,594 per ounce on January 29th of this year before a sharp correction. The demand is coming from every level of Chinese society, from the central bank to individual savers, all moving in the same direction, away from the dollar into gold. The second force is the fiscal mathematics of the United States government, and this is where the story connects directly to your wallet. The national debt crossed $39 trillion on March 20th of this year. It is growing at $7.23 billion per day. Interest payments on that debt now exceed $1 trillion annually, more than the entire defense budget, and triple the amount paid in 2020. The Congressional Budget Office projects deficits averaging more than 6% of GDP for the next decade, adding roughly $21 trillion in new borrowing. Debt held by the public is expected to surge from 101% of GDP to 120% by 2036. And $9 trillion in Treasury debt is being refinanced this year alone at rates 4 to 6 times higher than when it was originally issued during the pandemic. Foreign central banks can do basic arithmetic. When a government is spending more on interest than on national defense, when it is adding $1 trillion in new debt every 5 months, when its own budget office projects a fiscal trajectory that has no historical parallel outside of wartime, the rational response is to reduce exposure. The net interest cost the federal government pays on its obligations currently amounts to 3.2% of GDP and is projected to rise to 5.4% over the next 30 years. The Congressional Budget Office forecasts that interest will consume nearly 14% of all federal outlays this fiscal year. Chairman Arrington of the House Budget Committee said that it took roughly 200 years to accumulate the first trillion. And now we add that in a matter of months. These are not the words of a doomsayer on the internet. These are the words of the chairman of the committee responsible for the federal budget. The third force is the emergence of a concrete alternative to the dollar system. And this is the part that most financial media refuses to cover, honestly. The BRICS bloc, which now includes Brazil, Russia, India, China, South Africa, Egypt, Ethiopia, Iran, the UAE, and Indonesia, represents 46% of the world's population and 37% of global GDP. At the 17th BRICS summit in Brazil in July of 2025, member nations agreed to build digital payment infrastructure and expand trade using local currencies through a series of bilateral agreements. On October 31st of 2025, BRICS launched a pilot trade settlement mechanism called the unit. It is pegged to 1 gram of gold, backed 40% by physical gold and 60% by BRICS national currencies. It is designed specifically to allow member nations to settle international trade without using the United States dollar. Now, I want to be clear about what the unit is and what it is not. It is not a replacement for the dollar. Not yet. It is a pilot program, a framework, a proof of concept. But its mere existence represents a fundamental shift. For the first time since Bretton Woods in 1944, there is a functioning mechanism for major economies to conduct bilateral trade outside the dollar system, using gold as the anchor of value. And even if the unit captures just 10 to 15% of BRICS internal trade, that represents hundreds of billions of dollars in transactions that no longer require dollar intermediation. Hundreds of billions that no longer generate demand for Treasury securities. Hundreds of billions that strengthen the case for gold as a reserve asset and weaken the case for the dollar. And the numbers are already moving. BRICS nations collectively account for approximately 40% of global central bank gold purchases, with China and Russia leading in absolute acquisition volumes. A report from early 2026 found that total global gold demand surged past an unprecedented 5,000 tons in 2025 and the opening weeks of 2026. The SPDR Gold Shares ETF reached a record $150.3 billion in assets under management by January of this year. Capital is flowing into gold at every level of the financial system, from sovereign wealth funds to retail exchange-traded products. And the losers in this environment, as one financial analysis noted, have been traditional dollar-sensitive assets, with US Treasury bonds facing persistent selling pressure as foreign central banks that were once the most reliable buyers redirect their capital toward gold vaults in London and Shanghai. Meanwhile, China is building the physical infrastructure to support this transition. The People's Bank of China is promoting a plan to attract foreign central banks, particularly from allied or non-aligned nations, to purchase gold and store it in custodian warehouses connected to the Shanghai Gold Exchange. The Shanghai Gold Exchange, founded in 2002, has become the world's largest physical gold exchange, handling 54,000 tons in 2023, approximately 75% of global volume. China expanded its operations to Hong Kong in 2025 and operates over 20 major refineries with combined capacity above 2,000 tons annually. This is not theoretical. This is infrastructure being built brick by brick to facilitate a global monetary system that operates parallel to and increasingly independent of the dollar. The cumulative result of these three forces is visible in a single statistic. In 1999, the United States dollar accounted for 71% of global foreign exchange reserves. As of early 2026, the figure has fallen to approximately 58.5%. That is a 12.5 percentage point decline in 27 years. The decline from 71 to 65 took about 15 years. The decline from 65 to 58.5 took about 12 years. The trajectory is accelerating, and the foreign share of United States debt held by the public has declined from 49% in 2011 to 32% in 2025. The domestic private sector, including commercial banks and investment funds, has had to absorb what foreign buyers no longer want. That means American institutions are increasingly financing American debt because foreign institutions are choosing not to. And the Peter G. Peterson Foundation, one of the most respected fiscal policy organizations in America, calculated that over the next 30 years, the government is projected to spend nearly $100 trillion on interest alone. That works out to at least $47,000 per person over the next decade, just in interest payments. Not in services received, not in roads or schools or defense, just the cost of carrying the debt that politicians accumulated. The Peterson Foundation called this milestone staggering and noted that the speed of accumulation has accelerated sharply, with the latest trillion added in less than 5 months, a rate of fiscal expansion that has few modern precedents outside of wartime or acute financial crisis. When domestic institutions become the marginal buyer of government debt that foreign institutions are selling, the entire financial system becomes more fragile. American banks, pension funds, and insurance companies become more exposed to interest rate risk. And American savers become more exposed to the policy decisions Washington makes to manage that risk, whether through inflation, financial repression, or direct taxation. So what does all of this mean for your money? Let me translate the geopolitics into personal finance. When central banks sell treasuries and buy gold, several things happen simultaneously. First, treasury yields rise because the government has to offer higher returns to attract replacement buyers. Higher yields push up mortgage rates, car loan rates, and borrowing costs across the economy. Second, the government's interest costs spiral higher, requiring either higher taxes, reduced services, or more money printing. All three outcomes erode your purchasing power. Third, as global demand for the dollar declines, its value weakens over time. A weaker dollar means everything imported costs more. Oil, electronics, clothing, food, automobiles. The inflation you have experienced over the past 4 years is not purely a domestic phenomenon. It is partially a reflection of the world gradually diversifying away from the currency you use to buy everything. And the current geopolitical situation is compounding this pressure. The Iran conflict has pushed oil prices to 4-year highs. Gasoline hit $3.50 per gallon nationally, up 19% in just 2 weeks. The Consumer Price Index for February showed inflation holding at 2.4%, but economists warn this was the calm before the storm. If the Iran situation leads to sustained disruption of oil flows through the Strait of Hormuz, which handles roughly 20% of the world's daily oil supply, analysts project CPI inflation could rise to 3.5% by year-end. Gasoline could approach $5 per gallon. Airline fares could spike 20% from jet fuel costs. And food prices, already running 3.1% above last year, could accelerate as diesel costs drive up transportation expenses across the agricultural supply chain. Moody's chief economist Mark Zandi has warned that recession odds are creeping toward 50%. And the Federal Reserve, which held rates steady at 3.5 to 3.75% in March, acknowledged for the first time that the Iran conflict has introduced new uncertainty into the economic outlook. The Fed is trapped between cutting rates to support the economy, which would weaken the dollar further and risk reigniting inflation, and holding rates high, which supports the dollar but increases the cost of refinancing $9 trillion in government debt and puts pressure on banks still holding $306 billion in unrealized losses on their bond portfolios. There is no painless path. There has not been for years. But there is a prepared path. But the critical distinction between the people who will be damaged by this transition and the people who will be positioned on the right side of it is the same distinction that separates central banks from ordinary savers. The central banks are not panicking. They are positioning. They started this process years ago. You can do the same thing, starting today. First, protect your cash. If your savings are earning the national average of 0.39%, while inflation is running at 2.4%, with potential to reach 3.5% by year end. Due to the Iran oil shock, you're losing purchasing power every single day. The top high-yield savings accounts are paying 4 to 5% APY as of this week. That is the difference between your money shrinking and your money holding its value. Move your emergency fund now. It takes 10 minutes. It is fully FDIC insured up to $250,000. And the window is closing because rates will come down as the Fed eventually cuts. Second, do what the central banks are doing. They are accumulating gold at record pace because they understand that gold carries no counterparty risk. No government can default on it. No central bank can debase it. No sanctions can freeze it. The same asset that has preserved purchasing power for 5,000 years is being bought by the institutions that literally create money out of thin air. When the people who print currency are choosing to buy something they cannot print, that is the most powerful signal any asset class can receive. A modest allocation of 5 to 15% of your portfolio provides a hedge against exactly the forces at work right now: dollar erosion, debt spiral, geopolitical fragmentation, and monetary system transition. You can hold physical metals, buy exchange-traded funds, or open a precious metals IRA. Each approach has trade-offs in liquidity, storage costs, and tax treatment, and you should evaluate them based on your specific situation and consult with a financial professional. But the core principle is 5,000 years old, and it has never been more relevant. Gold closed around $4,560 per ounce on March 25th. That is down from a peak above $5,400 in January, largely due to a liquidity-driven sell-off during the Iran crisis, when institutions were forced to dump even safe haven assets to cover margin calls elsewhere. But the pullback is exactly the kind of entry point that long-term accumulators look for. Central banks did not stop buying during the correction. If anything, lower prices represent an opportunity to acquire more metal at better prices, which is precisely how institutional accumulation works. They buy on weakness, they accumulate on fear, and they hold for decades. Consider the math at current levels. If If you allocated 10% of a $300,000 portfolio to gold, that is $30,000. If gold appreciates to $6,000 per ounce over the next 3 to 5 years, which is within the range of forecasts from major institutions, including Deutsche Bank and Goldman Sachs, that $30,000 position grows to roughly $40,000, a 33% gain on the insurance portion of your portfolio, while the asset simultaneously protects you against the currency debasement happening to the rest of your holdings. And if the more bullish projections prove accurate, with some analysts forecasting $7,000 or higher by 2028, as de-dollarization accelerates and BRICS reserve diversification deepens, the returns on that insurance position become even more significant. This is not about getting rich on gold. This is about not getting poor in dollars. Third, optimize your tax position while the window exists. The fiscal math points in one direction. $39 trillion in debt, $1 trillion in annual interest, $21 trillion in projected new borrowing. Tax rates must rise. Converting traditional retirement accounts to Roth at today's relatively low rates locks in current tax treatment and insulates your future withdrawals from whatever rates Congress imposes to address its fiscal emergency. A phased conversion strategy, executed over 5 to 7 years to stay within your current bracket, is one of the most powerful legal wealth preservation tools available. Let me show you what this looks like in practice. Say you have $400,000 in a traditional IRA, and you are currently in the 22% federal tax bracket, which applies to single filers earning between roughly $47,000 and $100,000. Your bracket has room to absorb about $20,000 in additional income before you jump to 24%. So you convert $20,000 this year. You pay $4,400 in federal tax. The $20,000 is now in a Roth account, growing tax-free, withdrawable tax-free, with no required minimum distributions. You do the same thing next year and the year after. Over 7 years, you convert $140,000 at the 22% rate instead of waiting for Congress to raise rates to 28 or 33 or higher, which the fiscal math all but guarantees. On $140,000, the difference between 22% and 33% is $15,400 in additional tax you never have to pay. That is real money. That is a year of living expenses for many retirees. And it requires nothing more than a conversation with a tax professional and a few forms. And a self-directed Roth IRA can hold physical gold and silver, meaning you can combine tax optimization with hard asset protection inside a single government-approved structure. Your metals grow tax-free and you withdraw them in retirement without owing a dollar. Let me bring this full circle. In 1971, President Nixon closed the gold window, ending the dollar's convertibility into gold and launching the era of pure fiat currency. For 55 years, the world accepted the dollar as the primary reserve currency, not because it was backed by something tangible, but because it was backed by trust. Trust in American fiscal discipline, trust in Federal Reserve independence, trust in the rule of law protecting financial assets, trust in American economic and military strength to underwrite the system. Every single one of those pillars is under stress right now. Fiscal discipline has been replaced by $39 trillion in debt growing at $83,000 per second. Fed independence is being publicly challenged, with Chair Powell departing in May under political pressure. The rule of law governing financial assets was permanently altered when Russian reserves were frozen. And American dominance is being contested by a bloc representing nearly half the global population. The central banks have assessed these risks and acted. China has dumped $500 billion in treasuries and ordered its banks to sell more while buying gold for 15 straight months. BRICS has launched a gold-backed trade settlement mechanism. Central banks globally have bought over 1,000 tons of gold for 3 consecutive years. The dollar's reserve share has fallen from 71% to 58% and continues declining. These institutions have the best analysts, the most data, and the longest time horizons of any financial actors on Earth. They are telling you, through their actions, that the monetary system is changing, not someday, now. And history tells us exactly how these transitions unfold. The British pound held the status of the world's primary reserve currency for over a century before gradually giving way to the dollar between 1920 and 1944. That transition did not happen overnight. It happened through a series of fiscal crises, military overextensions, and the emergence of a more credible alternative. The people who recognized the shift early and repositioned their wealth accordingly preserved their purchasing power. The people who assumed British financial dominance was permanent watched their savings erode over decades. We are in the early chapters of a similar transition today. The dollar is not going to collapse tomorrow. It is not going to be replaced next year. But the structural forces driving its gradual decline as a share of global reserves are powerful, persistent, and accelerating. And the people who position now, while gold is still accessible, while Roth conversions are still favorable, while high yield rates are still elevated, will look back on this period as the moment they made the most important financial decision of their lives. Let me give you a concrete action plan. This week, check every savings and checking account you own. If any account is earning less than 4%, move that money to a high-yield account immediately. Second, research a modest precious metals allocation, 5 to 15%. Talk to a financial professional about whether physical metals, ETFs, or precious metals IRA makes the most sense for your situation. Third, contact a tax professional and ask specifically about a Roth conversion strategy. Ask them to model what a phased conversion looks like at today's rates versus the rates that the fiscal math demands in 5 to 10 years. These 3 actions, executed this month, position you on the same side of this transition as the central banks of China, India, Turkey, Poland, and dozens of other nations that have decided to stop waiting and start acting. The only question is whether you position yourself on the right side of that change or get caught holding 100% of your wealth in a currency that the rest of the world is actively diversifying away from. If this information was valuable, subscribe and turn on notifications. I am tracking this transition in real time and will keep bringing you the data and the strategies as they develop. And share this video with someone who still thinks the dollar's global position is guaranteed. They deserve to see what the central banks are actually doing with their money, even if no one on financial television will show them. The exit strategy is not coming. It is already underway. The central banks have made their move. The question is whether you will make yours.